Thank you. Welcome to the Halftime Report. I'm Scott Walker. Front and center this hour, a FOMO rally. One Wall Street firm says it is upon us. We'll discuss and debate that with the investment committee. Joining me for the hour today, Jenny Harrington, Jim Leventhal, Kevin Simpson, and Josh Brown. Let's check the markets here. On this Friday, we have a mixed picture. At least the Russell's red. Everything else is green. But as I said, Barclays today, Farmer Jim. Seasonality, the last 2 weeks of the year, usually the best for equities, hence FOMO is in full swing again. Michael Hartnett, Bank of America, today says investors are bullish, risk on Trump, Fed, Gen Z puts, tax, tariff, rate cuts. The only thing that can stop Santa Claus rally is a dovish Fed cut causing a sell-off in the long end. Citi today says no pain, no gain. They use the AI in both pain and gain in all caps, talking about AI. While we think we are in a bubble for equities, bubbles are initially quite profitable. We stay long equities. So There you go. There you have it.
So in the short term to the end of the year, I totally agree, Scott. I do think you'll have a Santa Claus rally. I also think that the last week or two that we've been kind of nudging up towards that record, but haven't gotten to there yet. I think that actually makes more of a coiled spring that when we do get past that, it will leapfrog past the record.
You're only 50 points away, right? Like
yeah,
about
I know
50 or so?
we're not far away, but it just feels like every day it feels like, hey, we're almost ready to go for it, and it doesn't quite get there. I think that's a positive. I think that's a little mini consolidation that sets us up for the springboard higher. There's also one thing on that long list of positives that I don't think I heard you say, which is the budget bill becomes very stimulative in 2026, both on the consumer side in terms of refunds coming in, no tax on tips, those things, but even more importantly on the corporate side with R&D expensing and CapEx expensing. I think that's very positive for the economy, for profits, and thus for the stock market overall. So I am positive. I'll say one last thing on the bubble question, because that word was used in there. Totally agree. I mean, bubbles, you have to inflate them before they pop. And
right, you have to inflate them to pop them.
Yep. And guess what? We're pretty early in the inflation phase, so I'm not worried about it popping right now.
All right, Jenny, how about you? I mean, three pretty positive notes as we head into the final stretch here.
Yeah. So the questions I'm asking is, do you want, let's say you have a portfolio and it's 80% stocks and 20% bonds, and you're going into 26 and you're thinking, okay, I'm going to leave that balance the same. My question becomes for 26, do you want that equity component to be the same as it was for 26 that it was in 25? If you were all large cap U.S. growth, or let's say you even had a lot of international, and international stocks are up 27% or so this year, do you want to rebalance? And do you want those to be the majority of your 80% equities or 70%, whatever you have, going into next year? I think maybe you change your playbook within your equity allocation. So I'm not saying get out of the markets, get out of equities. I'm just saying maybe change what you've got. And the reason for that is because I look at this market, this economy, this consumer as fantastic in aggregate. Right? In aggregate, the market's up 17%. In aggregate, GDP is showing nice growth. In aggregate, the consumer just spent 4.1% more on Black Friday than they did last year. But as soon as you disaggregate, it's a very different picture underneath. And so I think that different picture, it could change the dynamics in 26. I think if there's significant weakness in the consumer, it may start to bleed up. If it bleeds up, how does that change? If you look at GDP and you disaggregate it and take out that AI play, the rest of the economy is not in fantastic shape. How does that impact next year? So I think going into 26, there's a very different set of underlying circumstances than there were going into 25.
Right, well, so Josh, I feel like what you talked about the other day plays right into what Jenny's perspective right here today was. This notion, as she says, her words, change what you've got. You made the argument yesterday, as much as people want to say that or believe that, don't do that.
Yeah. So I think the mega caps, not just the Mag 7, but generally speaking, I think that's going to be the way that active managers who this year, like most years, in large number are trailing the benchmarks. I think that's the move that they're going to make. Doesn't mean that everyone watching the show needs to do the same thing, but I think they're going to look at some of the stocks that are mega cap and far off their highs and say, all right, maybe I didn't own enough Apple, made a new record high, maybe I missed the rebound in Tesla from the summer, maybe here's my opportunity. I got Microsoft in a drawdown. I got NVIDIA off its highs, Broadcom off its highs. I got maybe an opportunity in AMD. Look at Meta, blah, blah, blah. This is the trade. Amazon off its highs. This is what they'll do. Look, if it's not your strategy, I don't recommend going and running out and trying to do that. Jenny's got her own strategy, so I don't think she and I disagree. All we're talking about, Judge, is how they're going to behave into year end. Every year we want for there to be a new story, and every year it's the same old story. I just don't know what dislodges it this year.
Kev, I don't know. You know, we would be sitting here yet again in the early part of the new year saying, hey, should we, start diversifying away from the mega caps? We believe in this broadening story. Hey, look at healthcare, look at financials, look at all these other areas that are expressing this broadening view of the market. And then lo and behold, the earnings continue to hold up for the hyperscalers. They actually are being able to prove their return on investment. And then the money just starts to flood into that area yet again.
Yeah, and I think you're going to see a lot of that as window dressing into the end of the year, but we still have to get through the end of the year. And it seems like we're wondering, with respect to that, will there be a Santa Claus rally? Will there be a year-end rally?
Do you think there will be? I mean, the notes that I read you off the very top of the program suggest for a variety of reasons, seasonality and otherwise, that there will be. I
do agree with that. And the three catalysts that I'm looking at between now and the end of the year, Scott, two of them are next week. The first is the Fed. Did they give us the 25 basis point rate cut that we're factoring in? Yeah, probably. What's the tone of the meeting afterwards and the press conference and the setup for next year? You kind of expect rate cuts next year, but it'll be a catalyst for the short term. The other is Oracle's earnings. I know we'll talk about that later in the show, and we'll save that.
Yeah.
And the final thing would be the jobs report, which comes the following week. We would have gotten it today, but it's a data point that I think will set up the end of the year. So if we're looking between now and the end of the year for a Santa Claus rally, I agree with the notes, and I think we'll get it.
I thought that the Bank of America note today, the HeartNet idea of a dovish cut could be negative for stocks. That's a little counterintuitive, because if you came in and you said, well, they could give you a hawkish cut and that would maybe cause the long end of the curve, rates to go up, he's implying that if it's a dovish cut, that the market's going to get a little bit skittish on the long end about inflation, and the long end could go up anyway, and that could stop the rally. I haven't heard that perspective from people.
I think you're going to get that either way. I just think the bond market's already flashing that. When you look at the bond market saying, well, rates went up a little bit just on the idea that we've come up with a new chairman for the Federal Reserve, and that if things are too dovish, if there's not a complete data dependency, that you may be too dovish in an environment where inflation is returning into the marketplace. So I agree with that note.
Because
I do too.
There's your look at the 10-year yield, which has been going in really one direction. It's been backing up. The idea was, okay, Fed's going to cut next week, most likely. If they're hawkish, well, okay, maybe rates back up more. But now, if they're dovish, the bond market's going to have something to say about that.
And that's what I've been thinking for a while now, which is that we all know cuts coming. Right, we expect that. It's not so much about the cut that matters to the market. It's why. Why are they cutting? Are they cutting into strength, or are they cutting into weakness? And that's where I get back to my comment earlier about where I'm starting to worry about the consumer. I just saw something yesterday saying there were 1.1 million layoffs year to date. That's more than there have been since 2020. If they're cutting because they're really worrying about the labor market, that's a bad sign.
Yeah, I know, but people have been, maybe you and others talking about, oh, I'm worried about the consumer and this, that, and the other, and then they go to Black Friday and they spend hand over fist.
But that's the thing.
They spend
Who's spending?
Well, somebody's spending, and it's not just the top end either, by the way. It's just not.
It's a lot, though. And you go back to that McDonald's CEO comment from 3 weeks ago or something, where the McDonald's CEO said something like, and this is McDonald's, our high-end customer is fine. Our low-end customer is something like 15 or 20% lower than it was last year. McDonald's is seeing weakness in the
wasn't
low-end consumer.
Wasn't consumer sentiment a move higher today?
Yes, this is where I get really, really flummoxed in trying to think about the market, which is in aggregate, things are great. But when you disaggregate, it gets a lot trickier, and it's a lot harder to figure out, what stocks to buy. So everything I'm looking at,
you're making, if it's that hard to figure out what stocks to buy, you're making the case for why people are going to go buy the mega caps.
Okay,
that's
maybe,
exactly the point.
Let me just give you one really interesting example from yesterday. Yesterday, what shows up on my screen? Every week I run a screen and I say, show me what has above a 3.5% yield. I've got Bed Bath & Beyond. I'm sorry, not Bed Bath & Beyond. Body Works, Bath & Body Works, and Best Buy. right? Those are two totally different consumer bases, I think. Maybe I'm wrong, but I think. And to me, the trouble with Bath & Body Works is that is purely discretionary. So if you're feeling at all pinched, you're likely to cut that. You're less likely to cut, geez, my laptop just broke, I need a new laptop. So this is where it gets complicated. There's still opportunity. So you could say I'm making an argument for the mega cap, or you could say I'm making an argument for active stock picking and saying I'm not just going to buy consumer discretionary, but I'm going to suss out which of those has more
all
promise.
I'm saying is you could sit there and have a debate with yourself for 3 hours over Bath & Body Works versus Best Buy and try and determine whether you're going to buy that stock when the other person would say, you know what? I know where the pudding is being made in AI and in the hyperscalers, and I'm going to buy, to Josh's point, the sell-off in X or the sell-off in Y or the sell-off in Z.
Or you could say Apple's trading at 30 times with like low double-digit, 9 to 11% growth ahead. Or maybe I could look at a I keep saying the wrong things, don't I? Best Buy, which has been totally thrown out, has a cheap yield, has a cheap valuation, a high yield, has bigger upside ahead because the stock is so crushed. So maybe next year I get a 15% return in Best Buy and a 7% return in Apple. So you can start doing that kind of calculation.
I think the internals of the market show that both aspects are right, that the mega cap is obviously working, but so are a lot of other non-mega cap tech stocks.
I know. No, you said this the other day.
No.
You said the same thing the other day. And you named Delta Airlines and you named Wynn Resorts and you did that.
To you. You ready? I'm going to make you happy. I'm going to give you something you can really beat me up on. You know what's done fabulously this year?
To himself?
No, hang on, Jenny. Is GM, just as an example, it has nothing to do with AI.
Yeah, I know, but you sold it like a long time ago when you were worried about the tariffs.
Okay. I mean, as I said, I'm falling on my sword here. I didn't want to just
Can
be
I ask
talking
Jenny a question?
But hang on, let me just make the point, and then you can do this. I mean, look at healthcare. Look at financials. I mean, there are a lot of things. So both aspects of this can be right. It can be the AI stocks, and it can be the RSP equal weight S&P 500.
Josh.
I am worried about the consumer, and I think Jenny is right to mention that. It's the thing that's holding everything up other than AI CapEx boom. The AI CapEx boom is more delicate than we all think. If the consumer says that they are not prioritizing paying for all of these services that are being rolled out, or OpenAI comes out with a price increase for the next iteration of ChatGPT and people don't upgrade, or any of these types of things, all of a sudden you're going to see everybody with a laser focus once again on the Fed, on the jobless numbers, et cetera, et cetera. And the bad news here is that this is a very different labor market than we had a year ago at this time when we were talking about the outlook for 25. Challenger, Gray, and Christmas said layoff plans hit 71,321 in November, which is not as bad as October, but still enough to bring the year total, this is the number Jenny was searching for, to 1.17 million. And that's 54% higher. It's 54% higher than the same period a year earlier. So it's a different 500,000 planned hires, which is 35% lower than the prior year. So we have less hiring, we have more layoff plans. And so my question to Jenny is, why Best Buy in that? If you're as worried as I am that has the potential to get worse, we want to buy consumer electronics in the mall. That's what we want to do.
So Josh, I was saying these are the things that I'm looking at, and this is how that's weighing in. I'm not buying Best Buy, and I didn't buy Best Buy because I think broadly the consumer could get even weaker. But when you're comparing Best Buy and a Bath & Body Works, you have two really separate versions of consumer discretion that could come under pressure. So to answer your question, no to either of those in the end, but one is, I think, more compelling than the other.
I'm also not I'm not trying to make an argument in any way, shape, or form that the consumer, a good cohort of the consumer complex is hurting. That's quite obvious. All I'm saying is that for every bit of worry about that over the last year plus, it hasn't materialized into the consumer's this or the consumer is that. Somehow, there's been a resiliency that has been remarkable.
K-shape.
It's been surprising. It is K-shaped, but
far longer than a year, Scott.
It even is beyond, I think, just simply. I think it's too simple to suggest, well, the high end's doing great, and then the mid and the lower end are doing bad. Somehow, by virtue of those numbers over Black Friday, it seemed to be more than just the high end that was holding up the letter of the alphabet, if you will. Let's move, because I want to talk about the stock of the day. By now, you know 3,000 times over about Netflix and Warner Brothers. I want to tackle it simply from the Netflix perspective. I want to do it that way because Josh has made a move in that stock today, which is meaningful. You told us you cut your Netflix holding after the announcement of this deal by 85%. Tell our viewers why,
Yes.
because you've really liked this stock.
I still do, but I can't sit for a year and watch this become a political football and tie up capital. So it's just a portfolio management decision. I think there are going to be other opportunities that have more near-term upside while this Netflix thing works its way through the meat grinder in Washington. I want everyone to understand, I think Netflix right now represents a tremendous value, but I don't think the stock will be able to get out of its own way. The thing to keep in mind here is we don't know if an over-the-top bid comes. We don't know what Republicans are going to want to talk about as it pertains to this. We don't know what the Democrats will want to talk about. There's a lot of antitrust. There's a big antitrust contingent in both parties for different reasons. Then, of course, there's the White House. This would be the second largest merger or acquisition in the post-pandemic period worldwide, other than Norfolk Southern and Union Pacific, the railroad tie-up, at $85 billion. You cannot tell me the Eye of Sauron is not going to see this thing happening and say, what does this mean for us? And keep in mind, this is media, so it probably means something. I'm not telling you they have to put The Apprentice back on the air or it's going to be something like that, but don't be surprised if this takes over a year, produced by Barron. This could take over a year. So,
Yeah.
look,
Celebrity
I have
Apprentice.
tons
That's
of
going to be the
opportunity.
remedy.
Yeah. Right, I have
You have to
tons
bring
of
that back.
MAGA Apprentice. So all I'm saying is, I think Netflix is a great value. I think it's a great deal. I actually love the deal for them, not only for them, but I love that they're keeping this out of the hands of somebody else, equally important in the streaming wars. But I can't sit here, so I kept a very small position on, and we'll see what happens. We'll watch it for the next 12 to 18 months and see how this goes.
I thought some of the, Kev, you have the stock too. I thought some of the notes from the street today about the strategic nature of the deal and how it's a departure for Netflix from how it has historically done things. Huber Research says we've had an overweight for nearly the entire time over the last 10 years, but are stepping aside. Netflix has been very successful the last 15 plus years developing its own content and has smartly stayed away from doing sizable deals. We do not see the need to change that. Baird weighs in today. Certainly a deviation from the company's historical approach, and we understand the initial investor hesitation regarding the size of this deal and the potential closing integration process, but we suspect the long-term benefits will ultimately outweigh the near-term risks. You as a shareholder have to be willing to sit for the long haul. You have to have a bigger vision, but the notion that this is historically different than what Netflix is used to doing, not unlike you might hear if Apple was to make an acquisition of some scale larger than it's ever done before, you'd probably have similar notes.
Yeah, I hope we do see that from Apple, Scott, and I'm thrilled to see it from Netflix. I'm going to take the other side of this. I think it's incredibly wonderful to see them go on the offensive. This is an IP play that if the deal were to go through, and I agree with all the notes and Josh's comments that the likelihood is pretty thin. I also think that we'll see a competitive bid from Paramount Skyworks a hostile bid from them to keep this deal alive. But if it did happen, you kind of think of it like the Disney deal when they bought Star Wars and when they bought Marvel. When you're talking about some of these franchises, Game of Thrones, The Sopranos, the DC Universe, Harry Potter, what Netflix can do
Sex
with
in
this.
the City.
I never saw it. I think it's an amazing opportunity for this company to just take these franchises into a whole nother stratosphere. So I'm excited about the deal, and I'm happy.
What do you make
to
of
share it.
Josh's move to sell 85% of his stock?
I think it's a mistake. I think I would be more of a buyer of the stock if the deal does get blown up, the stock will go higher. And plus, the one difference between Josh and I is I can write covered calls against this. There's going to be heightened volatility now around this name, even more so
but that's why
than as they were a bidder.
That's why he's bowing out in such a large way. He would agree with everything that you've said, I'm sure, on the fundamental basis of this.
Yeah.
The stock itself, obviously the company itself, the leadership, likes all of it. But you're going to be in some level in what he suggests is purgatory for the next 18 to 24 months while this whole thing plays out. And then who knows how it ends.
You don't think it's in a box? You don't think it's stuck in a box now?
It may not be accretive to the bottom line, Josh, for 2 or 3 years. I don't disagree with that, but I don't think the stock's going to sit here and just level off. And if it does for me, which is different than for you, I can still write premium against it. So it's less of a concern for me for a range-bound stock. So I get what you're saying, but I would hate to be a seller at this point only to look back and say, look what happened. Look how amazing this deal turned out to be.
Let's turn our attention to a couple of names that have done quite well for Jenny this week. There are a couple of chip stocks, Microchip, Tech, and Teradyne. Since we're talking about things that are moving and stories that are in the news, Microchip today up 18%. It's the best week since April. Teradyne record high today. The shares were also up 14% last week. What's happening here? What are you doing with these?
So on Microchip first, the stock jumped because they pre-announced the December quarter. Bookings were strong through November. Backlog feeling was better, expected into March. And so that's it. It was kind of oversold. I think both of these stocks going into this were fairly valued compared to their peers. And that's why I'm always focusing on valuation. So the long-term thesis for us, for Microchip, has been inventory recovery. And that's what happened. You might remember we actually didn't buy Microchip. We bought the Microchip preferred coming out of Liberation Day. And so that's what we still own. Still has a 6.3% yield. And I think it's still a fair price. It's not wildly overvalued. On Teradyne, this one gets a little trickier. So we've owned this for a really long time. We've owned it since 2013. And we have like a 1,200% return on it. So where we sit today is it's kind of gotten caught up in the AI trade. And people are now looking at Teradyne as, as part of the AI chip boom. And so we've always, this one's in our disciplined growth strategy where there needs to be a 5% or better free cash flow yield to own it. This is down to a 2.3% free cash flow yield, trading at 39 times earnings. And so we're a little between a rock and a hard place where we're thinking, you know what? Even with the AI boom, even with AI chips, and that Teradyne plays a critical role in the AI chip production line, this is expensive. Does it still make sense for us? And we want to take some off the table, but we're 3.5 weeks from year end. It's a huge capital gain, so we may, and we don't think there's any imminent risk, so we may trim, but that'll probably happen after year end. But we don't like the valuation anymore. It makes us nervous, even though it's in the right space, and that's where you struggle with story and momentum versus valuation and cash flow yield.
Let's talk about some moves from you, Kev, too, before we get out of here. You sold Honeywell. Why'd you do that?
Yeah, this isn't a bear case for Honeywell. This is a stock that we bought for a breakup. If you go back and look at some of the other ones, famously General Electric obviously has been the most incredible divestiture. With the spin-offs, we thought that there would be a lot more attention to this company. We were essentially stopped out of the ticker HON. They spun off Solstice. We sold that. The gem's still in there. The aerospace materials, as I mentioned, came out first. Industrials are still in there, but no one cares about the stock. It's underperforming, and sometimes the price action alone forces us to move away from a position.
We talked a lot about the consumer, obviously, earlier. You bought more TJX.
Yeah, I was smiling when you and Jenny were talking about the consumer and Black Friday. TJ Maxx is a company that just continues to hit on every cylinder. It's not just for the discount shopper. I mean, every single layer of the economic sphere goes into TJ Maxx, to home goods. They don't have to deal with tariffs. It's both the trade down story as well as a story for the higher earners. So really, really like the way they're hitting on all cylinders.
You have a new buy as well. What's New Holdings? NU. Is that the ticker, NU?
It is. So be careful following me into this one, folks. This is an aggressive stock. This is a Brazilian fintech. This is in our growth strategy. This is also an IDEVO, an international fund that we manage. It's up 70% on the year. But what we like about this is the reminiscence, the echoes of what we see with Robinhood and some of these other online companies that are benefiting from just this pure Latin American play. So Brazil alone, I think the index is up like 50% year to date, but they're still 25 to 30% off of where they were pre-pandemic, 2019. So this is a $16, $17 stock. I like it. We're taking a flyer with it, and I look forward to talking about it over time.
Okay, you do that. We'll follow you on that. All right, we'll take a break. Coming up next, our top calls of the day. We do have a target hike for a big betting stock today, and later Josh Brown's back. New edition of his best stocks in the market list. Halftime is back in 2 minutes. Let's talk about some calls of the day. We start today with Shell. Got downgraded to neutral from buy Bank of America. They believe the balance sheet strength remains underappreciated. That's one of the stories. However, we believe removing some execution risk discount will likely require a lower commodity price environment and correspondingly more amenable sellers. What do you think?
Yeah, I had a hard time figuring out why they actually downgraded it at first, but I guess what the gist of the downgrade is saying that a lot of their earnings growth is going to come from acquisition through M&A activity, and so with a lower oil price, they can buy those companies much more cheaply, and then that drives their earnings in the long run. So, okay, fine, that's their opinion. They've moved it down to neutral. Here's where we see it. We're holding it. We love this company. They're a huge player in the LNG production space, but more importantly, the numbers are just there. They produce incredible amounts of free cash flow, and here are the numbers. 3.8% dividend yield, 15% free cash flow yield, 12 times earnings, increasing buybacks. They bought back 10% of their shares in the last couple of years. So if you think at around $58, $59, oil is probably not going too much lower, which is what I think, then it's probably a great time to get in. If you think oil is going to 40, hold off. If you think oil is going to 70, buy a lot now.
Okay, Kev, Unity got upgraded to overweight at Wells Fargo today on, number one, favorable industry backdrop in 26. 2, direct exposure to the direct payments migration with Unity Commerce.
Yeah, I mean, this is a risky one also. I think they're coming out of the other side of a turnaround. I'm thrilled to see Wells Fargo upgrade it. They've got to deliver. We'll have to watch the next 2 earnings report to see if they can. There was a lot of problems at this firm when we purchased it. We think that they're coming out. 3D gaming is something that's pretty cool and exciting. The commerce side of it also very impressive, but I would tread lightly on this as well.
Rocket reiterated top pick, $25 at BTIG. That's a pretty big upside from here, Josh Brown.
Yeah, stock's going to go. I had a conversation with the CEO, Varun. He knows exactly what he's doing, building the first integrated, complete end-to-end funnel for the home buyer. Every step on the journey, from financing to the transaction to the servicing itself, all of that will be done by one company. That company will be Rocket. They've invested big while the housing market's been frozen, and as that thaws out, they're going to reap the rewards.
All right. It looks like that stock's moving a little bit. Freeport McMoran. The target goes to 58, reiterated. It's overweight at JP Morgan.
Right. So we own this one. And copper is up 36% year to date. Freeport's up about 20%. They had this huge mudslide, which was pretty negative for business. But again, where you look at it today, you've got 16 times earnings, 8% free cash flow yield. And we all know that copper is in enormous demand. Everything EV, everything solar, wind, AI, like all of that requires copper. So there's endless demand here. And Freeport's one of the best pure play ways to have that exposure.
All right, DraftKings, that's the one we teased earlier. Target goes to 45. BTIG says buy it.
I'll be thrilled if it goes to 40, let alone 42 and 45.
Yeah.
You know, the prediction markets really messed up what was happening with these online companies, and now DraftKings and Flutter are both getting into prediction markets. So I think it helps them, but I still like Robinhood better than both of them.
All right. It is that time. The best stocks in the market list. The spotlight shining brightly today on AME, better known as Josh.
Ametek. This is a 95-year-old company. Founded in Pennsylvania in 1930, came public in 1984. Stock has been wrestling with this $200 level since November of 2024. It's been a full year of digestion. If you pull this chart back, please do this for me, Vin. Let me see 10 years. I want to show people the long-term trend, and then we'll come back to this because it's really important. These stocks that are making components for industrial, for medical, for electricity generation, for power, aerospace and defense. There's probably like 50 of these things running around, and very few people know them by name. They haven't been popular stocks, but they have all undergone a once-in-a-generation re-rating because of how important they are to all of this onshoring activity and the AI CapEx. Look at this trend. My God. All right, now give me the moving averages. So, once upon a time, this summer in June, I brought a stock to the air called Amphenol, best stock in the market. It was 93. We said it's breaking out. People said, Josh, this stock was just 50. Why are you talking about it at 93? Well, shut up, because it went to 145. Because the market is not that stupid. And when they take stocks to record highs and they break out, there's often a fundamental driver. In the case of Amphenol, it was massive earnings growth. In the case of Ametek, this is a company that's expanding margins like crazy. Like crazy. Every quarter, margins are going higher. Why? Because the things they make are more and more in demand. So I like this name right here. I think it breaks 200 finally after a year of consolidation. As far as downside, I think 180 to 182 is a reasonable stop. That's both the rising 200-day moving average and the bottom of the prior gap from the last time they reported. No earnings till February. All we have in front of us is trend.
That is passion, ladies and gentlemen, from Josh Brown. Passionate.
I am very good at this.
Been on the list since October 30th, 2025, came public in 1984. One of the most important players in some of today's fastest growing industries, as Josh said. Thank you very much. We will see what this stock does, and you know we'll track it from here, as we always do. We have a trade alert to tell you about. Josh Brown, tell us what you just did.
Yeah, so I'm in Adobe now. It's a small trade. I think the stock can recover back to 400. I've been tracking this thing the whole way down. I was looking at it during the course of this week. I understand all the bear arguments about how everyone's going to throw out their creative licenses and just outsource visual effects, et cetera, to OpenAI. I just don't believe it. I don't actually think that's what's going to happen. They had a good earnings report. Stock's been in a relentless downtrend, down 55% from its high. And what I'm looking at technically here is a name that sort of wants to snap that downtrend potentially. So I don't know if it will happen. I do have a stop loss here. There's not an endless leash, but if it does snap its downtrend finally after a year of horrible performance, I feel like the recovery here could be fairly swift. One thing worth pointing out, and I think it's really important, this is the original company to be a case study at Harvard for reinventing itself. In 2014, they went 100% subscription and became a SaaS giant. It's still studied to this day, the boldness that Adobe had to make that transformation. Now it seems obvious everybody should be software as a service. This is a company that's got that in its lineage. Don't be surprised if they reinvent themselves for the AI age. It's 14 times forward earnings.
Jimmy, you got a friend.
I know.
You needed a friend.
I didn't expect this, Josh, but good on you. It's a brave move. Look, here's what I'm going to say about it.
I got
Josh
your
just
six.
laid it. All right, thank you, brother. You just laid out, what's been ailing the stock, the concerns that AI is going to eat its lunch and kill its customer base. But this is a stock that has outperformed on earnings quarter after quarter for years. And if you look at the last 3 quarters, the negative price movement after good earnings has become less and less. I know it's a terrible thing to say, but look, this is the truth. 3 quarters ago, great earnings, it goes down 14%. 2 quarters ago, great earnings, it goes down 5%. 1 quarter ago, great earnings, it's basically flat. I think that means we're going to get great earnings and it goes up. So, Josh, good on you. I'll talk to you next week.
You got to be so happy now that
unexpected. I mean, unexpected. It just
at least include Josh. We'll do finals next. 3 o'clock Eastern closing bell. We're going to close out the week with Jeremy Siegel of the Wharton School, so I hope you'll join me for that interview coming up in a couple hours' time. Kevin Simpson, what's your final trade?
I'm going to go with New Holdings, Scott. Massively underbanked opportunity, great fintech in Latin America, strong earnings growth.
Josh Brown, your final?
ESX breaking out to a new year high, raise the roof.
The Good Farmer?
Vertex, good momentum building here.
All right, Jenny, what you got?
Disney. The Warner Brothers deal shows the value of content. Should increase Disney.
Oh, okay. That's interesting. Thank you very much. I'll see you on the closing bell coming up 3 o'clock Eastern time. Right now, I'll send it back to HQ.
That Wall Street is increasingly bullish on their S&P forecast for next year. Our next guest is in that camp. He sees the S&P rising to 7,700. Joining us to discuss his rationale, Ed Yardeni is president of Yardeni Research. Ed, it's the roaring 20. Who would have thought when COVID hit in 2020 that we'd be sitting here with the market up how much in the past couple of years? Is it extended by historical kind of metrics, this rally that we're in, or is this fairly normal?
Well, once we recovered from the sell-off during the lockdowns in 2020, it took about 6 months to recover. From that point, the market's up 100%, basically. The S&P 500 is up that much, and much of that is attributable to earnings. So we've had a very resilient, very strong economy in the face of lots of shocks. And as a result, we've had very strong earnings, and here we are. Kelly, as you know, I think you know, back in 2020, it was November 2020, I actually first started talking about the roaring 2020s and kind of looked delusional back then, but now it looks pretty good, and the question is whether it can keep going.
Yeah, because my husband, when we're doing like the 529s and there's all the numbers and the this and the that, and you're like, geez, you hate to buy at the top of a 3-year run, but what would it have 80% from the lows or something? Can you give us some reassurance?
Well, look, I think the reassurance is in the performance of the economy. The economy has been resilient because the consumer has been resilient. I know there's a lot of controversy about whether that can continue, but I think a lot of the resilience owes to the fact that baby boomers are retiring with an all-time record high of $80 trillion in net worth. We've never had a bigger, richer, retiring segment of the population than we have right now. And they're going to be spending that money. They're already spending that money. And I think that'll continue to make the consumer resilient.
It's funny that you mentioned that, Ed, because quickly I've heard that actually being part of the bear case. There are people who say they're all now doing required minimum distributions, and that's going to put selling pressure on the market structurally.
Well, it's not like it all started today. I mean, as you know, those RMDs have been going on for the past several years. They're all not all retiring at the same time. In other words, they certainly aren't retiring all at the age of 65. Quite a few of them are working in their 70s and maybe even into their early 80s. But the reality is the baby boomers are spending money, and they can't seem to spend it fast enough because when you put away a nest egg, you presume that you're going to be eating those eggs during your retirement, so your net worth will go down. Instead, the net worth's going up for a lot of baby boomers because they own equities.
And now, Ed, it's Dom. One of the reasons why it's been curious, the market action, has been because we see so many strategists like yourself, your peers and colleagues out there, who've been incrementally, seemingly raising their targets for the end of next year just over the last couple of months. What do you think is actually driving that incremental positivity? Is it the idea that earnings are going to get better? Is it that multiples are going to expand? Is it a combination of both? What's driving it?
I think it's probably mostly earnings. I don't think most strategists, maybe not any strategists, really expect the valuation multiple to have much more upside. We're already talking about 22 to 23 forward PE, and back in the tech bubble of 1999, we got to 25 on the forward PE. So I don't think too many are expecting valuation to go higher. The stocks are already fairly expensive on a historical basis. But I think everybody's getting more confident about the outlook for earnings. Look, over the past 4 years, we've had the most widely anticipated recession of all times. It never happened. And the stock market has been through a lot of stress tests over the past 4 or 5 years. And yet here we are, as Kelly said, all-time record high in GDP, all-time record high in the stock market. So I think it's just more confidence in the ability of earnings to grow. And I think people are looking at all the stimulus that's coming out of fiscal spending next year. It's the nation's 250th anniversary. There'll be plenty of parties and spending that way. And of course, the soccer games are going to be very stimulative to the U.S. economy.
I say, Ed, like you're I watch my life trajectory. I've gone from a hater to a lover. I go, Ed was right about everything. I should have just listened to him all along. But I'm a millennial, and I had to live through the financial crisis, and I'm worried every time we go to new all-time highs in the market. And I look back and I go, he was singing Kumbaya the whole time, and he was right.
Kumbaya, it's been so far. But look, it's not as though there aren't any risks whatsoever. I'm carefully watching what's going on in the credit markets. That's where you usually see the cracks before the stock market sees it. And you can certainly point to some issues with regards to the private credit markets. But all in all, I think with all the stress tests that the economy's been through, it's very likely that it'll remain stress resistant going to the rest of the decade.
It's fascinating. The roaring 20s. All right. Sounding better and better. Ed, thanks very much.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Walker, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with the hunt for a new record high. The S&P not that far away from yet another market milestone in 2025. We'll ask our experts what's in store for your money moving forward, including the Wharton School's Jeremy Siegel. He'll join me in just a moment. Let's show you the scorecard here with 60 to go in regulation today. We're still on track for a positive week, trying to get a little something going here late on this Friday. Energy and tech are leading the way today. Been a solid week for Meta on that metaverse report from a couple of days ago. Micron is up 5% this week, and a pretty good one as well for the banks. We're going to have a closer look at that space coming up. A very, very good performing group this year. The big banks are, and they're looking pretty good today, too. It does take us to our talk of the tape. Can stocks stage an end-of-year run? Let's ask the Wharton Professor of Finance, Jeremy Siegel. He joins us now. Professor, it's always great to talk to you. We usually do this on Fridays, which affords us the ability to size up this week and the past few weeks at that. I mean, how does this market look to you here?
The market looks very, very solid. I'll tell you one thing, I don't think we can rely on seasonal predictions. You know, we all said, oh, September, October are normally weak months. November, normally the best month of the year, and it just squeaked out a little bit of a gain. December is usually a good month, but it can go either way. Actually, one of the most reliable periods for December is the trading days between Christmas and New Year's. That's up almost 90% of the time. So we could reach new records. I'm actually fairly pleased with what I'm seeing in terms of holiday sales. I was a little fearful that tariffs might impact those sales, but Black Friday was good. Cyber Monday was fairly good. Not gangbusters, but it shows an economy that, you know, is moving at a, you know, probably 2.5% GDP pace. One thing that's so unusual, Scott, I mean, yesterday, when I saw jobless claims go to more than a 3-year low, and the day before that, on Wednesday, seeing the ADP employment report showing the lowest level in almost 3 years. I mean, that is something that is just never supposed to happen. I mean, the labor market is so hard to interpret. This is the most extreme no hire, no fire economy that we've ever seen.
It's funny, Professor, you know, there are some notes today that do talk about seasonality being in our favor, as it tends to be, especially when you come into December with such a strong year leading into it. But there's also a mention today of FOMO, that it's in full swing yet again, that there are a lot of portfolio managers who have underperformed this market. Maybe they couldn't be as large as they otherwise would have wanted to in some of the mega caps. So now the chase is on. Is there something to that?
Well, there is, but again, you know, the Mag 7 has been the outperformers, and they've been relatively weak, actually, over the last 4 to 6 weeks, which is a little bit surprising. Now, maybe some people will say, I've got to get them on my balance sheet in the last couple of weeks of the year. You do get some of that evening up that's happening. But I'm actually rather pleased to seeing the rally broaden out. And right now, I actually see less FOMO than I think I saw maybe 4 or 6 weeks ago.
Oh, interesting. You know, the other idea is what Citi puts forth today, Professor, where they say no pain, no gain. And they use the A and the I in pain and gain in caps, and talking about a bubble. We think we're in a bubble in U.S. equities, they say, but bubbles are initially quite profitable, so stay long. This is like, well, I guess you have to inflate it before you pop it, so we might as well ride this as long as we can.
You know, so just a minute. Is this like 96 or 99? There's a big difference about that. And by the way, that internet bubble was many times what we're seeing now. You know, not in both the tech stocks and the non-tech stocks. I'm actually pleased to see some caution in the Mag 7 recently. And I'm not saying, you know, I mean, Tesla, Palantir, there's a few of them that do have those triple-digit PE ratios, but the others, PE ratios of 30 when you're growing 20% plus a year and beating on all metrics. I'm not saying they're the ones to own, but certainly I wouldn't say that they are in bubble territory. And once you subtract the Mag 7 or the related tech, you get PEs that are under 20, which in my playbook is absolutely not a bubble. So I am not in agreement with Citigroup's analysis here.
When you talk about certain kinds of stocks, and you mentioned Palantir by name, I'm wondering, given the number of markets you've seen over the years, you've seen many stocks that have acted like this one over the years, how do you tell an investor class, so to speak, as the professor, how to judge a company like that? It's a totally legit, real, great business, right?
Yeah.
With a firebrand CEO who doesn't take any you-know-what. And this company's got some real stuff going on. Yes, it trades at a high P, but it also has a very loyal cohort of investors behind it, not only institutionally, but retail.
Well, Scott, everything you're saying right now could be said of Tesla, right? A very, CEO that's in the limelight, who's done amazing things, PE ratio well over 100. We know if it is just if Tesla was just a car company, it would be selling at about $30 or $40 a share. It's all those options on what Elon Musk can do, might do. Of course, that's a $64 question. All the things that car can do, might do. But both of these companies, Palantir and Tesla, show so much more substance than the crazy internet companies that were being bought in 2000.
I guess that's kind of my point, right? Is you have to make a distinction, even while we make analogies to different periods of time and market caps and valuations, et cetera. There are clear differences that need to be pointed out. Let me ask you this. The backup in interest rates, concerning to you in any way?
We're going to see the Fed next week. I've always said that even if the Fed lowers, I actually see the 10-year between 4 and 4.25. I think you have to lower the short end because the short end is usually 1 percentage point below the long end, and that's why it belongs in the low 3s. We'll see how the bond market reacts. What's causing some of this backup today? It's hard to say. Are they worried about Kevin Hassett, that he might, kowtow to Trump a little bit too much, lower interest rates a little too fast, a little too much? It could be a little bit of, the oil market has ticked up a bit. I wouldn't call, 411 to be something to be concerned about, certainly quite yet.
I'll ask you this then about the Fed, since you bring it up. I think people think they're going to cut next week.
Yeah. Oh, I think it's, yeah.
Absolutely, you say.
Well, nothing is absolute. I think it's going to be a very hawkish cut. Which
you do?
What means they're going to cut, but put in the language that they're apt to hold in January unless they see the economy, significantly deteriorate or inflation come down dramatically. So that is what I think the message is going to be next week.
I wonder if you're getting into a cutting sweet spot of sorts, where, as evidenced by the inflation data today, you had core coming in lower than expected, and yet you do have concerns about the labor market. So those who are arguing for multiple rate cuts might just get their way, no?
Yeah, well, multiple, what's going to happen next year? Early next year, Trump says he's going to, name the new chairman, and that makes Powell kind of a lame duck. What does that mean? I wouldn't want to go beyond predicting next week too easily at this particular juncture. But, my call is for a hawkish cut. I think there's going to be dissents, 2, maybe even 3 saying no cut, Certainly, I think Myron wants a 50 basis point cut. He will continue to dissent on that other side. This would be the most dissents, if this happens, that the Fed has had in many years, if not decades, which might be a sign of, the disagreement and what the transition that, if it is Kevin Hassett, is going to be facing when he becomes the new Fed chair. Or if he becomes the new Fed chair.
I asked Mohamed El-Arian this question yesterday, who the equity market, not the bond market, not the credit market, who the equity market would prefer as being Fed chair, and he had a tough time answering that question. Can you answer it? What do you think the market would want?
I think they would want Kevin Hassett. The equity market tends to want towards an easier side because it rides inflation much easier. I mean, we're not talking about inflation 6, 7, 8%, but tending a little bit on that easy side rather than let's squeeze it down to 2. Clearly, that's not going to be good for the bond market. But when we take a look at things, easier money that might be a bit inflationary is actually much more of a sweet spot for the equity markets. So I think that Kevin would be better in that sense than Waller, particularly, who didn't vote for that, quarter point when they held that earlier this year, or maybe how Warsh would be. So I don't think there'll be a negative reaction on the equity markets to Kevin. There might be a little bit of volatility in the bond market.
Okay. Stay with me, Professor. Let's bring in our other panelists, if we could. Requisite Capital's Bryn Talkington, Neuberger Berman, Shannon Sakosha. It's great to have both of you contributors with us, of course. Bryn, you first. Hawkish cut with dissents. That's the prediction from the professor for next week. Seems like the market's in kind of wait-and-see mode for what the Fed says. How do you see it?
I like that phrase a lot. I think that's totally on point. And I will say, when I look at my Robinhood prediction market, it shows 74 cents that it is Kevin Hassett. And I think the market has digested that. I do think that we are going to get GDP growth continue to be stable to growing next year. And also, especially in Q1, I think there's going to be really good tax refunds, really good for the consumer. The data center part of growth in GDP is close to 50%. Plus, we have the fiscal side of stimulus from the OBBB. And so I think, to talk what you were talking about, rates backing up on the long end, as the long end rates come up, that can also tell you that the economy is strengthening. And so I think right now, today, we have some issues with Japan. Obviously, the yen and JGBs continue to go higher on the JGB side, which I think is putting some upward pressure. But I do think that steepening of the yield curve a bit while short rates are coming down is a positive thing, because it's telling you that the economy is doing well.
Shan, size this market up for me.
Well, in the short term, Scott, there doesn't seem to be much that can upset the momentum. To the professor's comments earlier, if we look at the last couple of weeks of December, there is going to be some window dressing. And I think there could be some window dressing, frankly, Scott, on some of the lower quality names. I mean, we've seen quality really suffer, especially in this last 3 or 4 months. And so I think, those quality managers might be reaching for some of those names that are lower quality. But I think most importantly, I do think the positioning going into 2026 and the broadening out, the health of the market, I think we're poised for that broadening to continue to some of these other sectors. And if you think about the importance of AI CapEx next year, it's going to come from companies that have strong balance sheets that actually can invest in these innovations outside of technology. And so I think we're on the precipice of what could be a really interesting period. There is this liquidity infusion, as Bryn mentioned, coming into the market in April or so. There's been over withholding from a tax perspective for many higher income households. And so there are some catalysts outside of just lower rates and economic growth that could create a liquidity infusion that could allow for this additional broadening out and not be an either or scenario with mega cap tech.
I'll tell you where there's been a liquidity infusion. It's the financials. If you look at what these stocks have been doing, certainly over the last month, it's been pretty exciting to see if you're long that group. Leslie Picker's been following it. Les, what's behind this, do you think?
That was the perfect pivot there, Scott. KBWB, that is the KBW Bank ETF, hitting a new all-time high today. And that ETF pulling in gains of about 26% year to date. Its 5 largest holdings, the biggest banks, each up at least 22% this year. Citi has a smaller weighting in the ETF, but it's the best performer of those big bank cohort this year, up 54%, thanks to progress on its turnaround plan. Investment banking, of course, has been busy, and the macro and regulatory backdrops have been conducive for banks as well. And the likelihood of rate cuts next week at the highly anticipated FOMC meeting, helping ease some credit quality fears that were sitting there at the margin. And also next week, Goldman Sachs is hosting its financial services conference starting on Tuesday. We will be there in person to track the insights from management teams on how the fourth quarter is shaping up and any guidance for 2026. Scott.
All right. Well, good. We look forward to seeing you there. Leslie Picker, thank you so much with the perfect setup for us. So, Professor, if I told you you could not pick anything related to AI, technology, or what have you, where would financial stocks rank in your list of areas of this market that you like?
I think what's just been said is true. First of all, lower interest rates would stimulate loan demand. We've actually seen a turn down in delinquencies. Remember, the rising delinquencies is a problem. October, November, the latest data is actually better on that. That's absolutely good for banks. So that is certainly one of the sectors that could benefit, as well as any sector that really begins to use AI, in a way to save costs and increase margins. The AI adoption, all these great possibilities, but it's been a little on the slow side. There's a lot of room for margin gain and cost cutting here.
Bryn, you get a little net interest income nirvana the steeper the yield curve gets, right? For these stocks, they love that.
Sure, and I also think within our business, within our industry, AI is absolutely working. I think we all see all of the efficiencies we're getting from being able to do things already inside of our ecosystem. But I also think if the economy is doing well, if rates are coming down, you could also have a play in the regional banks. And so I know we're talking about the money centers and the really mega cap banks, but as rates are coming down, that could also be very stimulative for some of the healthier regional banks.
Well, I'll tell you what, it's probably one of the reasons why the Russell 2000 is up 2.5% over a month. I mean, they obviously have a lot of regional banks in there. Shan, what about you on the financials? Leslie gave us a good setup, and these stocks, if you look at their performance, certainly on a year-to-date basis, it's pretty impressive.
Yeah, I mean, I think Bryn's spot on with her points. But the other thing that we haven't talked a lot about, because there hasn't been as much of it as expected, is really on the M&A front, Scott. And so not only do you get that infusion from an investment banking perspective, but you also, for those businesses that have a wealth arm, being able to take those liquidity events, convert them on the investment banking side, and then be able to move that over to the other side of the ledger from a wealth perspective. There's also $8 trillion sitting in money market funds right now, Scott. And so if you think about trading volumes and the opportunity to put that money to work in 2026, especially in a stronger economic backdrop, there's a lot of opportunities in different parts of the financial sector to take advantage of that.
All right, ladies and gentlemen, thank you so much. We'll see you soon. Look forward to our next conversation, Bryn, Shannon, and the professor. Meantime, SpaceX reportedly kicking off a secondary share sale that would boost its valuation $800 billion. $800 billion. Morgan Brennan is here with those details. Step aside, OpenAI. Hello, SpaceX.
100%. That is the headline here. And yes, let that sink in. $800 billion valuation. This is according to the Wall Street Journal, which is reporting that SpaceX is kicking off a secondary sale, and it would be a doubling of the valuation for SpaceX since its last secondary sale, which was back in July. Just a little bit of context here. Twice a year, give or take, usually around the summer and then usually again around this time of the year, SpaceX offers these secondary share sales for investors, for employees. I have reached out to the company. I have not heard back for comment. I'd also just note for context, I don't, in recent memory, ever actually seeing SpaceX comment on one of these sales. But at $800 billion, it would be the most valuable U.S. private company. It would surpass OpenAI with that valuation as well. And in terms of SpaceX, it obviously has different parts of its portfolio, but the one that investors have continued to be most excited about is Starlink, which is that broadband satellite constellation. They now have upwards of 9,000 satellites in low Earth orbit. It is a very profitable business from my understanding. And as we show you rocket launches on the screen, they continue to surpass all of the records around rocket launches with that business as well. They're upwards of 160 launches so far this year, Scott.
All right, good stuff. Morgan, thank you. We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli and HSBC's Max Kettner are here to break down these crucial moments of this trading day. Plus, Mackenzie Sigalis is tracking the action once again for us in crypto. Courtney Reagan is watching the big move today in Victoria's Secret. Michael, I'll begin with you. What do you make of how we're going to end this week?
Look, we're holding the gains. I think that's the story of the week. We had this nice kind of 5+% comeback in the S&P 500. The market kind of got back in gear in terms of cyclical leadership. Banks, even consumer cyclicals this week did outperform. Small caps did better than big caps. So it is the market sort of migrating to this view that we might get a reacceleration in growth. Also, probably appropriately for this time of year, you've kind of bled volatility away. So you kind of went back to a 15 and change VIX. We were right there at the end of October when the market was pretty much at these levels. So you've done the round trip, and now it's about, do you have the upward drift because it's December? And really, I guess the question is, what's your starting point going into 2026 in terms of valuation and expectations for earnings growth? That'll settle how things
I'm going to get some from Mackenzie in a minute on what Bitcoin's actually been doing.
Sure.
But are we still tied up in that Bitcoin knot a bit as it remains weak?
I mean, less so. We're trying to kind of disengage from that to a fair degree. In fact, if you plotted like the NASDAQ 100 against Bitcoin on a one-year basis, NASDAQ 100 is sort of like lifted off. So I don't think you can have Bitcoin under liquidation in an aggressive way and have the rest of the market hang in there effortlessly. But it's been relatively impressive that we've been able to shake off the fact that Bitcoin still remains a little bit stalled.
Tell us more about that, Mac. I mean, it just can't seem to get out of its own way right now.
That's exactly right. Cryptocurrencies are back in sell-off mode. Bitcoin, again, below 90K, and Ether is barely holding on to that 3K line with almost $500 million and mostly long positions liquidated over the last day. And that break lower, you were talking about it with Mike, it stands in sharp contrast to equities. The S&P 500 is edging toward new highs on growing bets of a third Fed rate cut this year, but anything tied to tokens is trading like it is risk-off. Miners like CleanSpark, Bitfarms, and Hive Digital, as well as centralized exchanges including Coinbase, Bullish, and eToro are all ending the day in the red. You see that same pressure in the crypto treasury names. Tom Lee's Bitmine Immersion and Strategy, key proxies for Ether and Bitcoin, are both sliding today, and spot Bitcoin ETFs just ended yet another week of net outflows, led by BlackRock's IBIT, which just logged its biggest month of outflows since launching. Scott?
Yeah, we'll watch this closely, of course. Mackenzie, thank you. Mackenzie Sigalis. To Courtney Reagan now. What has Victoria's Secret soaring? Tell us.
Yeah, I mean, Victoria's Secret is out, right? According to its CEO, Hillary Super, its product, brand, and experience are working together to soar past the street's expectations for the quarter. The intimate apparel retailer putting up stronger than expected results with growth across brands and categories, albeit still posting an earnings loss for the quarter. Comparable sales, though, growing 8% with merchandise selling at higher prices due to less discounting. Super told me it's raised its outlook as a result of, yes, the strong third quarter, but also some conservatism with regard to consumer spending in the holiday quarter, because you just never know. Though she's seen no sign of consumer spending strain in her business in any income bracket. Now, she said Victoria's Secret did grow its customer file for the first time in a while, with the key 18 to 24-year-old cohort coming in for the product, not the promotion. Super told me the fashion show during the quarter had a, quote, measurable and significant impact on all of its key performance metrics. Several analysts, too, are raising their price targets as shares move higher to the tune of 17% today. Scott?
All right, Court, thank you. Ms. Courtney Reagan. All right, Max, we're heading into a pivotal week. We're going to hear from the Fed chair. What do you think is going to happen?
Yeah, look, I think it's a bit of a nothing burger next week. I think probably, with the sort of 50-50 labor market weakness that we've got a couple of better data points this week from the labor market. But there are still these cracks, I think, particularly in the beige book from the Fed a couple of weeks ago. That is probably enough evidence for the Fed to cut next week. That's obviously fully priced. And I don't think that this sort of hawkish narrative that seems to be more and more consensus that the Fed is going to go for that next week. Why should they be cutting a third time in a row and then suddenly say, well, actually, you know what? We're not really convinced of this, that actually we think things are way better and we're completely done here. No, they're still going to highlight probably downside risks. And that should be enough to keep probably the front end pinned down. That should be enough also for risk assets to take quite a bit of a relief from that.
Top of our program today, though, the professor of the Wharton School, Jeremy Siegel, suggested we're going to get a hawkish cut. He said, you just dismissed that as a real possibility?
No, I mean, look, it is a risk, fair enough. But why would they do that? Why would they cut a third time and then absolutely nail the door and say, look, you know what? No, we're completely done here. And we're going to raise, maybe something like the 2026 dot or the 2027 dot, or indeed maybe even the long run dot. Why would they do that when, actually we have seen quite a bit of weakness in some of the preferred labor market data from the Fed? I think it's a different thing when we go towards Q1, perhaps, around March, if we then start to see some of the government shutdown related data weakness come out and possibly see a bit rebound in Q1 activity data. If by then the Fed says, hold on, you know what, this is not just a rebound from Q4 weakness, this is a genuine reacceleration, then perhaps by then it's time to be a bit more hawkish. But I think that is too early to do that right now.
What if rates continue to back up? That can't be a nothing burger, can it?
Yeah, I don't think that is a nothing burger, but it will take time until we call this the danger zone, until it really hits that danger zone. So we've got one model where we look at really when spread valuations, when EM assets, when equity multiples are really being hit from higher yields and higher treasury yields, particularly on the back end. That only starts from sort of 450, 460 on the 10-year. So we've got an awful lot of room to go. I think what will be hit, if indeed that is the case, then it's probably a bit more the speculative corner of the market, the small caps and so on, that would be hurt by that. But again, that is absolutely not our base case.
This sanguine view, Mike, sounds that Max is obviously espousing sounds like I'm hearing from a lot of people.
Yes, I do think that's the case, that people are basically sort of believing in the reacceleration story. Obviously, consensus earnings growth looks like it's going to be low teens at minimum into next year from what we know right now. Maybe the market can broaden. We can hold our valuations. Don't worry about credit. Don't worry about the Fed. So yeah, I do think there's a concern, and maybe it's something that really doesn't come back to bite the market until somewhat deep into the first quarter, where everyone builds up a lot of optimism, and then you have something of a rethink. But I think you have to be aware of what assumptions people are working with. I also don't think the Fed is going to be assertively hawkish, but they may be non-committal. I mean, they cut twice in a row, and Powell came out and said, don't expect another one necessarily. So yeah. I think it's much more about we can live with that if we're talking about the economy perking up.
I'm still remembering what he said word for word last time. It's not a foregone conclusion, exactly. ... Far from it.
And he still has a committee that's probably conflicted, and he probably has to reflect that. He's going to have the dot plot to explain away. So plenty to talk about. We'll see if the market's looking for an excuse to back off. To me, that's what always matters. You wait for the Fed, you see the reaction. It meant the market needed to do one thing or another.
Yeah, well, they're going to ring the bell in a moment. Mike, it's good having you. Max Kettner, thanks to you. Good weekend to you both. We'll finish positive on the S&P 500.
Hello, welcome to Blue Cloud Trading. I'm George. It's Friday. It's December 5th. Market's closed. It's currently 7:25 p.m. In this video, we're going to cover a number of the stocks that they talked about on today's halftime report and closing bell. We saw Josh Brown. We saw Jeremy Siegel. And let me show you a list of stocks that we're going to actually cover in this video, guys. It's a lot. It's a lot today. About 23 stocks and ETFs. Not all of them, but a good portion of the stocks they talked about. We're going to look at the index ETFs, the SPY, the Q, the Dow, the Russell. We're going to look at the Mag 7 stocks, some of them, not all of them. We're going to look at sectors and ETFs like gold and Bitcoin and everything else, including Chewy and Snowflake, two of our members' requests. So before we get started, let's do this. Let's go ahead and take a look at the indices here. How did they perform? Dow Jones up 0.22%, NASDAQ up 0.31%, S&P 500 up 0.19%, and the Russell 2000 down slightly 0.42%. Let's look at this segment right here. This tells us a little bit about some of a quick little summary of what happened. You can see the S&P 500 and NASDAQ extended the win streaks to 4 sessions, closing near all-time highs. The September core PCE inflation cooled to 2.8%, boosting expectations for Fed rate cuts. The Dow gained over 100 points, while small caps underperformed today, right? Large caps tech stocks performed on renewed AI optimism. Dollar General surged 14% after the strong Q3 earnings. Yeah, Salesforce and Ulta Beauty rallied following positive earnings reports. Media stocks jumped as Netflix eyed a $72 to $83 billion acquisition of Warner Brothers Discovery Studios and streaming division, including HBO Max. That's pretty huge. And then Carvana, CRH, and Comfort Systems USA soared after hours on news of the S&P 500 inclusion in December. They will be included now in the S&P 500. Very interesting. How did the individual stocks do in the S&P 500 today? Here's a list. You can see Broadcom, AVGO was up 2.42. Google and Meta were up. Amazon was up slightly, and so was Tesla. Oracle, Palantir up, Microsoft up, but Apple down slightly. So was Nvidia. The healthcare stocks didn't do particularly well today. Basic materials was mixed. Energy didn't do particularly good. Utilities also down a little bit. The industrials mixed, and so was consumer defensives. Let's look at the groups here. You can see what individual sectors were the top performers. It was communication services, technology, and consumer cyclical. And utilities, energy, and basic materials were the worst performers today. This is the 1 week performance. Technology at the top, utilities at the bottom. Okay, let's get into the charts now, and we're going to use the Ichimoku indicator, my favorite indicator, to help me assess what's happening. How strong is this? How strong is this trend that we're currently in with the S&P 500? It's very strong. Here we are on the daily chart right now, and as you can see, by the way, if it has a blue flag next to it, any of these stocks or ETFs that you're going to see as I go through them, that means that they're bullish on both the weekly chart and the daily, meaning that they have almost perfect technicals on both time frames. Okay. Here's the S&P 500, for example. We have a bullish. What's happened today is the Senkou span A crossed above the Senkou span B. That's that light colored blue line. That's a very bullish signal. You'll notice that you'll always see the cloud projected 26 periods into the future. Okay. And whenever price comes down to it, it usually acts as a level of support, whether it's at the top line or the bottom line. As you can see right there, I found support and bounced. Let me show you one more thing. Here's a weekly chart so you can just get a more clear understanding of how this indicator works. The green line is the 9 period. It takes the midpoint of the last 9 periods. The red line is the midpoint of the last 26 periods. This one's called Tenkinson. This one's Kijinsen. This is Senkou span A and Senkou span B, those two lines that create the cloud itself. Senkou span A is derived by taking the midpoint of these two moving averages. It's projected 26 periods into the future. The Senkou span B is basically taking the midpoint of the last 52 periods. Instead of showing it under the candle, it projects it 26 periods into the future. That's what comprises it, okay? And then you've got the Chikou span, which is the lagging line right there. That's today's closing price projected 26 periods into the past. So we're covering the past, the future, where we currently are. And this indicator is very, very, unique, obviously, right? Because it tells us a lot. And then I also have the 200-day superimposed here. So if price is above the 200-day, that's a very positive signal as well. I've got the directional movement index. What we're looking for here is the green line to be above the red line. Okay, that's important. We want that white line. That white line represents momentum. So if the momentum is declining, it just means that it's not really moving that much. And you can tell just by looking here at that weekly chart, for multiple weeks now, we've been stuck inside this box. So yeah, it's been looking very positive, but really we haven't really moved. We haven't broken through these levels here. This is multiple weeks now. This is 6 weeks in a row that we're kind of stuck under that level. So just keep that in mind on the weekly chart. And here it is in the daily, right? So we're basically still consolidating, in my opinion. And until we can break through that 689.70 level, and we're very close to it, extremely close. That's the prior high from here on October 29th. I mean, you got to go back to October. We were at this level back in October 29th. We came down, found support of the cloud. We're now retesting that level of resistance. The good news is the momentum is building up. That's the white line that you see right there, the ADX. The green line is moving up. The red line is moving down. The volume is increasing. All of these things are telling me that there's a higher probability that we're going to break through and have that Santa Claus rally like they've been talking about on the show. We'll see if I'm correct. All right, here's the Qs. How's that doing? Same situation here. It's basically still under that 637.01, but it is meeting all the criteria. It's above the moving averages and looks good here, okay? Dow Jones, same thing, all right? 484.39 is the level that it needs to break. How far are we from that? About 0.92% away from all-time highs. Russell 2000, also stalling at the 250-277. Very interesting, right? So don't get overly excited quite yet. In my opinion, we need to break through these levels. We need to see the momentum build up some more. I want to see some more positive volume here, breaking above that 50-day moving average. Right now, we've been kind of like stagnant here with the volume, right? And every time that we reach this level, let's hope we don't get another pullback here. That would suck. All right, so then we got FEZ, the Euro stocks. Also above the cloud. Everything looks good here. Okay, Chico's band is above price. Like I said, we want that to be the case. But we're stalling at that 64.36. This particular ETF has another high of $66. This purple line represents a monthly level. The light red is the daily. And a light blue is a weekly level. So if I switch it to a monthly and I go back in time, there's the high. I mean, we're talking about, what is that? That was back in 2007. Back in 2007, FEZ was at $66. How far are we from there? From the $66, we're about 3.5% away from that 2007 high. Very interesting. A lot of times price reaches a level of resistance and then retracts. But if it breaks through that level, now we've got something, a continuation and potentially a continued bull rally into 2026. So let's see what happens here. VIX declining again today, so that's good. Here's the daily chart, down 2.34%. We want that volatility to be coming out of the market. This is like what they call the fear index. So when this is declining, it's telling us that basically there's less and less fear. People are becoming to put a little bit more risk on the table. They feel more comfortable with adding positions in this scenario. All right, now we're going to get into the stocks they talked about. These are the CNBC stocks that they talked about today on the shows. Now there's 23 of them. Again, we're going to run through these quickly. I've already highlighted, I've reviewed all of them. And I can tell you the ones with the blue flags are the ones that look the strongest. The ones on the bottom, not so much. And let's get into them. I'll explain what, I'm not going to get into, like I said, we're not going to spend too much time on these, but the technicals look pretty sound. Here's Unity Software. Everything, it meets all the criteria for the Ichimoku Cloud. Chico span above price above all the moving averages. It looks like it's probably going to find some resistance around this area. It has found resistance at 46.94. Okay, so that's an area that I would be watching. And I probably wouldn't add any positions until it gets above that level. Because, like I've said before, when price comes to a level of resistance, it's more than likely to pull back. But it has touched that level twice now, once, twice, and this is the third time. So you never know, right? Sometimes that's all it takes is one more try above and it breaks through. The momentum is still increasing. Goldman Sachs. Here's a perfect example of what you do want to see. You want to see it breaking through. This is what happened today. It broke through that level, up 2%. The financial services sector, this is the capital markets. ADX is moving up. Volume is increasing. I like Goldman Sachs. FCX is looking good. The only problem with FCX, even though it was up 1.32% and it meets all the criteria that we're looking for, is the fact that it is so extended now above the moving averages. That's dangerous territory. It's already made its run. I think that, it's more than likely to pull back at this point. So I wouldn't be jumping in here quite yet. I'd maybe wait and see if it can pull back and, give us a more interesting, more cheaper price to get in, basically. If it comes closer to the moving averages, that makes more sense. XRT also kind of expanded and extended above quite a bit. Now, the good news is it did break above the cloud. This is the retail ETF. The cloud also turned bullish. The Chico span turned bullish, but those moving averages are so far away. So that's something to keep in mind. Here's a weekly chart, also looking good, right? TER, this is Teradyne, broke through this week above that 191.56 level. Here's a daily chart. Those are all-time highs that it's hitting. So that's very, very bullish for TER. I think we talked about this yesterday or the day before. General Motors also broke through this high of 72.87. Guys, I want you to notice what happened. It came to that level, declined, came to that level, found resistance once, twice. But once it breaks through, like on that candle, notice how it stayed above it and stayed above it again. It pierced it. That's what that wick represents. The wick represents that the price dropped a little bit, but then finally closed above, right? Above that 72.87 level. And just remember that you can identify all that stuff by, there's something called, let me just show you guys my Twitter, over here on Twitter page here, at Blue Cloud Trader. Next, in this tab here under highlights, scroll down, and this is the candle pattern reference sheets, just so you understand candles. All right, again, the wick represents the low. The upper wick represents the high of the day. If it's a red candle, this is the opening price. If it's a closing, if the at the end of the day, if the price dropped, okay, there's the closing price. It's going to be red. If it's a green candle, the opening price is at the bottom. That's the bottom of the body of the candle. The close is at the top of the body. But this wick, again, represents the high of the day, and the wick on the bottom represents the low of the day. So it tells us a lot of information. And then these are some of the patterns that you'll probably hear me talking about. Bullish patterns, single, double, and triple candle patterns, and then bearish patterns. So, yeah, consider you can download that for free from the Twitter page. Again, find that in the links section. General Motors, I like, okay? There's a daily, here's the weekly chart. All-time highs for GM. The MAG's looking good. The MAG 7 ETF. It had dropped for 3 weeks in a row right there from November 7th. And now it reemerged back above last week on Friday, November 28th. And then here we are a second week now, and it's looking like it's going to continue moving up. Here's a daily chart. We have a positive crossover right there. The future cloud also turned bullish. You always have to, like, when I'm zoomed in like this, you're not really getting a good aspect. I have to kind of zoom out so you can see the full 26 periods into the future here of the cloud. So it looks bullish. The only thing about MAGs is the Chico span is still underpriced. So that's not everything is perfect here, but it looks like it's probably going to cross above pretty soon. And if it does, then you're going to have a perfect chart, basically, as far as this indicator is concerned. Remember, when price is inside the cloud or under the moving averages, it's not usually a good idea. It's not usually a good idea to add a position, because that can be a more extended, it can take a while for that to correct itself, like it did over here, for example. You can see that big drop. But once it emerges above the cloud, you have a higher probability trade. AME is Ametek Inc. It's in the industrial sector, which was up today, up 0.29%. I like this one too. And here's the weekly chart. There's KBWB. This is the Invesco KBW Bank. This one looks great too. I mean, you can see that it was kind of stuck in this little consolidation area, right? Broke above. That's a daily chart. 3 days in a row now it's moving up. A little bit far away from the moving averages though. KRE also looks good. I like the regional banking ETF. KBE looks good. We have a positive cloud forming. We're above the cloud now since November 25th. Now, the rest of these don't look so great. Remember, I've already reviewed them. They don't have a blue flag for a reason, and that's because something technically is really off about them. Even though the price of this stock was up 5.33% today, it is still under the cloud here, and it's under this declining 200-day moving average on the daily chart. If you look at the weekly chart also, it's been in this downward channel for a very, very long time. And one candle does not change the course of a embedded decline. Here's some other examples of candles that were bullish, that were under the cloud, that never materialized into anything. Here's another one. Okay. Here's another one right here. And here's another one. This is called a bullish engulfing pattern, and it could be the end, but there's no clear way to identify that, and that's why it makes more sense to wait for it to break through the cloud first, because then now all of a sudden you have an established uptrend and you have a higher probability trade. All right, so here's Micron. MU is the ticker symbol. Let's look at the daily chart on this one. I had a position back here and got out of there back on November 10th. Now it has declined and now it's recovering again. It's up 4.66%. The cloud is bullish on the daily chart and it looks good on the weekly as well. Palantir. Okay. Palantir also broke today on Friday above the Tenkan-sen on the weekly chart. That's a very bullish sign. What about the daily chart though? And this is why I didn't get a blue flag, folks. Let's look at the daily chart. It's still inside the cloud. I mean, it's been moving up. It looks like it's probably going to break through it, but it has not yet. And so you have to determine if you want to take that chance. The cloud itself is bearish still. The faster moving average is still under the slower one. In price is still under the cloud. And we still also have a series of lower highs and lower lows. Here's a lower high here, okay, from the prior one. And we also have a lower low here from this low. All right, but we did break that trend line, and that's a good sign. And now it does appear to be moving up. We'll see how long this lasts. Maybe it will break through, but then again, maybe it will stall here and drop some more. Who knows? But that's Palantir. Next earnings are going to be on February 2nd. MCHP, Microchip Technology, Inc., Semiconductors, daily chart breaking above the cloud, but the cloud is still bearish. Just keep that in mind, all right? Here's the weekly chart. Also breaking above the cloud under the 200. It looks like there's something happening here with MCHP, but on the daily chart again, we have a lower low here from this low. But I like the fact it almost looks like a V-shaped type recovery that we're seeing here, right? Straight up. So that's a good sign. It did break through that 200. It got above the cloud, but look, it also created a reversal candle here. That's a red spinning top. That's a bearish candle. All right, so that's why not a good idea to be adding here. BBY under the cloud, so no on that one. That's Best Buy. Honeywell is under the cloud. No on that one. BBWI is also, that's Bath and Body Works, still in a decline. This thing has been in a decline since forever. I mean, look at it. Going back to mid-2024, it was at a high of $53. It's down 64.77%. It's been down for a while. Here's a weekly chart so you can get a better picture. Okay. Where it got under the Tenkan-sen right there. The 9 period on the weekly. And this is precisely why I recommend that you look at both time frames. Because the daily might look fantastic and then the weekly chart might be a mess. And this is a mess of a chart right here. And yeah, we have a couple of weeks of bullishness here, but we had that back here too. All right. RKT, Rocket Companies Inc. Here's a weekly chart. Looks pretty good in the weekly, except for this shooting star. That's a negative candle. On the daily chart, pulling back and re-entering the cloud so it does not get a blue flag. So maybe it will pop again, but right now it doesn't look perfect. Shell dropping under the cloud today. That's a bad sign for Shell. Netflix continuing its decline, down 2.89% today. But they did make those big acquisitions, right? And sometimes a company's punished for some, when they do stuff like that. But I think long term, Netflix it's going to be a very positive thing for Netflix acquiring HBO Max. I mean, for sure. More content. That's a good thing for Netflix viewers. DraftKings Inc. Gambling under the cloud. No. New Holdings looks pretty good on the weekly chart. What about the daily though? It crossed under the Tenkan-sen today, but I think this has a higher probability of rebounding here. And the reason I say that is because it stalled at the 1655 level, which is a support level. It's based on these. You can see this high right here of this candle. You can see how it came. Whoops, my bad. I just moved it. Let me make sure I get that right. 1655. Let's fix that. Okay. So you can see how, again, price came close here, dropped, came to that level, dropped, came to that level again, dropped, broke above it. Now it's above. Okay, now it's pulling back. It might give us a nice new opportunity. And remember, financials are looking pretty strong today. So I wouldn't be shocked to see this thing bounce, even with this big red candle. All right. Let's see what else. So we went through 23 stocks very quickly, like I said, right? We don't have to spend too much time. How about Tesla? Tesla gets a blue flag today for the first time in a while. Why do I say that? Because it crossed above the Tenkan-sen and the Kijun-sen right there. Okay, that's what gives Tesla the blue flag. It also crossed on the cloud itself. What I am concerned about with Tesla is that it's still under this trend line, this extended trend line that you see right here. If I look at the weekly chart, for example, and you can see this prior high of this candle and this high, right? That's how that trend line was developed. You can see it stalled right there, stayed under, stalled there, stayed under. Has not broken that trend line, has not broken the 488.54 level, this prior high. So yeah, it's looking more bullish, but it only moved up 0.10%. It's not a big jump. Apple down 0.68% today, creating a shooting star pattern, but it's pretty close to the moving averages. It's holding up above the 277.32 level, which is based on a daily chart, which is this candle here from October 31st. Meta. Okay, under the cloud, skip that one. You don't even have to spend too much time on that. Microsoft is under the cloud as well. Not the time to be adding. It's a great company, but not the time to be jumping in here, folks. All right. Interesting about how I did get out of that at the right time, didn't I? 8.4% profit on that last trade from July 24th until July 31st. I had a couple of other trades here as well. And then it never did get back above. You can see that prior high right there. Let me just show you. From this high here, if we go extend it out, notice how price came right to that level of resistance. And what happened? It dropped, right? And now it's in an embedded decline. So we'll see. We'll see what happens. It did stall at the 200, that rising 200-day, and maybe this thing will turn into something. It does look like it's forming a higher low from the prior one, but we still need to take out this high as well to actually create a upward channel, which we don't have quite yet, okay? And then Amazon, that's under the Tenkan-sen and Kijun-sen still. All right, let's keep going. All right, let's look at the sectors very quickly. Now, these are the strongest ones. I've got them flagged with a blue little flag here. XBI, Biotech, up just 0.13%. Looks good on both time frames, okay? Like I said, I've reviewed all these on the weekly too. Energy, all right. Now, energy, it was looking great this morning. It moved up quite a bit. If we look at the 5-minute chart, you can see that right there. Here we are on the 5th. It moved up straight up, and it was exactly around 11:30 a.m. Price dropped under the Tenkan-sen. Everything started to fall apart. So it dropped, moved up, found resistance at the Kijun-sen, dropped some more. Okay, came back up, was never able to basically get back above the Kijun-sen again. We had a negative crossover. The Tenkan-sen crossed under, stayed under. Notice how price was held down by these moving averages here. Notice right there too. That's an interesting thing right there. Look at those moving averages. Unlike the traditional moving averages that are kind of more smooth, right? These will flatten out, and it's mainly because instead of taking the closing price and using that to plot, right? It's taking the midpoint of every candle. It takes the high, the low, divides it by 2, gets the midpoint. And so you're getting a very good average of the movement, right? Day by day of the highs and lows. All that volatility is being basically, plotted here on this with these moving averages. And so as price drops, it stair steps downwards, okay? And right now I would not be adding positions here, honestly, with energy, okay? Because I don't like this candle on a daily chart on Friday. Just a reminder of what that looks like. Here it is in the bearish patterns here, right there. Okay, so you can see that if the price has been moving up, and all of a sudden you get one of these types of candles with a very long wick. I mean, even the gravestone doji, that's also a negative one, right? But that's what we're looking at right there, and that's bearish. Now that same exact candle, if you see that same exact candle and it's at the bottom of a move, all right, I'll show you right over here, for example. They call that an inverted hammer on this bullish side here. If price has been declining and you see that exact same candle, it's bullish, okay? Just like the hammer here is bullish if it's at the bottom of a decline, but that same looking candle at the top of a move is called a hanging man. All right, so very interesting. And the spinning top basically works the same way. If you see a spinning top at the top of a move after it's moved up, and you see one of these, that's bearish. If you see one of these after price has dropped, okay, that's a bullish signal. So this is a negative signal. And let's look at the weekly chart. The weekly chart is fine. There's nothing wrong here with the weekly chart. That daily chart does concern me a little bit, though. I will say that. I do like the fact that the momentum here in the weekly is still very bullish for energy. Okay, it's still above the 200-day moving average. Overall, looks good. I think this is a little bit more of a stock picker's market anyway. It's not more, but so like I think there are a lot of individual stocks to be focused in on more. GDXJ, Junior Gold Miners ETF, is pulled back a little bit. It's above the 105.24 level, just kind of creating a base is what that's called. And it's just taking a breather here, I think. There's nothing else happening. The Tenkan-sen is still above Kijun-sen. We have a bullish cloud. Chikou span is above price. Everything still looks good. We are close to a level of resistance, the 112.45. All right, we are approximately 5% away, 5.2% away. So are we going to create a double top? Who knows? Or will the gold miners continue their move up? Only the 112.45 level will give us that information. Once we get to that level, if we break through it with a lot of momentum, volume, it's going to give us a signal. Copper, miners ETF. That one broke above here, above that prior high of 66.20. It's continuing to move up. Even though this is a reversal candle, it's staying up. I like that one. XLC looks good. XLC broke yesterday. Okay, communication services broke above the cloud. Like I said before, you want to see price getting above the cloud first. It makes sense. And it did. It broke above and it's moving up. It's continued to move up now. The cloud itself is starting to become very bullish. The Senko Span A is almost above the Senko Span B. We have a rising 200-day moving average. If you look at the directional movement index, remember what I said earlier about what we want is the green line to be moving up, the red line to be moving down, and simultaneously this white line, the ADX, to be moving up. That represents momentum increasing. So that we got all that stuff going on. Let's look at the volume too. The volume, if you look at the volume bars here, today's volume was higher than yesterday's. Right there. Okay, so that's also another signal that you can utilize. And look at this, the Chikou span itself. Remember we talked about that? The white line crossed above the candle 26 periods ago. That's a good sign right there too. So we've got a lot of things happening here for XLC. SMH, semiconductors, also turned kind of bullish today. We got a bullish crossover. The Tenkan-sen crossed above the Kijun-sen. The cloud turned bullish once again. There's been a little bit of crisscrossing happening here, but it is getting close to that prior high, guys. That's the main reason we're seeing all this. If I throw a weekly chart, go ahead and throw a weekly level of resistance here. Based on that candle from October 31st, the high was 372.78. We're going to color this blue to represent the weekly level. Okay, so the dailies again that's a daily level right there. So that we don't really have to worry about that. That's based on that candle. So yeah, it's just kind of like I said, it's got to get through that. And we're not that far away. We're only 2% away from those all-time highs for SMH. XLY looks good. Bullish cloud formed finally today. A positive crossover. Okay, that's not bad on the daily chart. In the weekly chart, we're already established here in a nice bull trend. Silver. Look at silver today, up 2.30%. So the metals, they've got some potential here. Silver and gold tend to work, in unison. Not today. Gold was down 0.18%. We're going to look at that in a second, though. But look at the volume here for silver. Okay. And the directional movement index also looks good here. That's the weekly chart. There's a daily. So it looks like on the daily chart, it's kind of building a little bit of a base again, right there. Stuck in that little range. If it breaks above that, expect it to expand some more. Gold looks good. I mean, nothing negative to say about gold. It's also building a base, similar to silver. Okay, right there. The Chikou span is above price. Tenkan-sen is above Kijun-sen, and the cloud is bullish on the daily. And here's the weekly chart. Still holding up above the Tenkan-sen, so it looks good. The rest of these ETFs, not so great. I'm just going to run through them very quickly. Not going to spend too much time. Here it is under the cloud. That's Oil K, the K1 Free Crude Oil Strategy ETF. No on that one. Bitcoin dropped 3.47% today. I wouldn't be adding positions here. Real estate is also, XLRE is also negative. Utilities dropping into the cloud some more, down 0.94%. XLV dropping. That's the healthcare ETF dropping, down 0.42%. Now, unlike XLU, which is under the cloud, and that's extremely bearish, XLV has potential to bounce again. Okay, it's pulling back right now. The weekly chart is still very bullish with price above the moving averages, but it did reach that high of 159.64 and it pulled back a little bit, which concerns me. So it might just make sense to hold off on adding new positions and managing your existing positions, really. XLP, consumer staples. Inside the cloud, no on that one. XLK looking okay, but doesn't get a blue flag because the faster moving, the Tenkan-sen is still under the Kijun-sen. Chikou span is still under price, and we still have a bearish cloud. Okay, that's the XLK. Here's the weekly chart, which looks very bullish. So you can have one time frame look great and the other time frame not so great. You're not going to have, if you don't have both of them in unison, you're taking a gamble, essentially, in my opinion. It's more of a gamble. And so just keep that in mind. Industrials, XLI, industrials looking pretty good on the daily chart. What about the weekly, though? Weekly looks good. Actually, let me look at that daily chart again. Oh, the reason I think I didn't give it the blue flag is because of the Chikou span only. That's the only thing that's negative here. Chikou span is still under price. So otherwise, I like industrials. Doesn't look terrible at all. Financials, also, like we talked about, also looks almost perfect. We get the cloud here is about to turn bullish. Single span A is about to cross single span B. Chikou span is above price. Price is above the moving averages and the cloud. And on the weekly chart, we're looking very bullish. So financials doesn't look terrible, like I said earlier. XHB, home builders. We have a negative crossover of Tenkan-sen under Kijun-sen, but it's very close. It could just as easily get back above that again on the weekly. On the daily chart, though, it does look like it's more bearish here. It's under the cloud, so I'd hold off. XLB materials is also under the cloud right now, but it's above the 200. It's above the Tenkan-sen, Kijun-sen, and we just had a recent bullish crossover under the cloud with a higher high here from the prior one, and we have a higher low here from this low. So XLB might turn into something. We have a future bullish cloud that's starting to turn bullish here in the daily. On the weekly chart, it's almost there too. It's just struggling. All right, and then let's take a look at these two stocks. Chewy. All right, let's see, folks. What do we got here? Chewy, consumer cyclical sector, specialty retail. Let's start with a weekly chart. It is currently, today, closed under the cloud. Now, with that said, it is holding up inside this box, and it's still above that 200-day moving average. Every time it comes to it, it finds support and bounces, and continues to stay above it. This is concerning that it closed under, but sometimes it can be just a 1 week situation, and then it could come down here during the week, for example, next week, and bounce again. and then we break through, and then it can continue moving up. But right now, would I be adding any positions? And the answer is no. We get a bearish cloud right here. And notice how this is what you don't want with a directional movement index. We don't want that red line to be above the green line like it is in this case, and the ADX moving up, because the ADX 9 is agnostic. It doesn't really care which line is above which, whether it's the red line or the green line. This just represents the momentum, and that's increasing. So if that's increasing, the white line is increasing, and the red line is above the green line, that's not a good sign. But I will say this, I still, obviously, price is being contained here, all right? And that's the weekly. Now let's look at the daily. And there it is. So you can see that, it looks like a crossover, a positive crossover might happen here. The Tenkan-sen crossing on the Kijun-sen right there. It's at the exact same level of 33.12 is where that is. And it's finding some support. But it's a bearish pattern. And so I would not add new positions here. Okay? Snowflake. What you need to do in this situation is just manage this trade, and it's up to each individual trader to determine their risk tolerance, whether they are okay with holding it for a more extended period of time to see how it progresses, if it can, basically recover from this decline. Snowflake. Here's another example of what happened today in this stock. This one also dropped under the cloud. All right, we have a series now of lower highs and lower lows. Okay, so there's that, and we have a downward channel basically here. We're also under the cloud. Look at the directional movement index. This is not a good sign for the daily chart. And if you look at the weekly chart, also breaking under the Kijun-sen, it's more than likely to pull back some more. Okay, down 2.55% today. So I would not be adding positions here. And that's all I've got for you on that one. Guys, thanks for watching. Don't forget, I'm doing a members only video tomorrow, which is a lot more comprehensive. I go into the individual, like I said, we're going to go into a much more vast grouping of sectors. So like, I'm just going to give you an idea of what I'm talking about. If we look at XLE, all right, that's a very small representation of this energy sector. You really can't make it a clear, concrete, idea about how the energy market is doing based on this ETF. Why? Because again, it's only about 24 stocks in there. That's not a big representation. However, check this out. This is SX90. This is TC2000's software. They have created this symbol to represent a much more vast number of stocks. How many? Okay, let's take a look. If I click up here in the component watch list, 245. So you can see the list. It gives us a much more comprehensive idea using, again, the same stuff concept of how to recognize the strength of the trend. You can see here SX90 looks pretty strong here on the weekly chart and on the daily chart, although we did get this negative candle. So again, that's one of the things I'll do. And then within this sector, I'll go a little bit more in depth, okay? So for example, once we're in energy, okay, these are the industries that pop up, and we can look at each individual industry, oil and gas refining, for example, and we'll get an idea of that. And then I can find the stocks within, okay, within that industry. And I talk about the strongest ones there. Oil and gas, drilling, oil and gas, E&P, oil and gas integrated, oil and gas midstream, and every one of these sectors has its own industries, all right? Basic materials has these metals, for example. We can look at gold, all right? And so that's my point. So look out for that members only video again. To if you want to check it out, click on the join button, and yeah, we'll be doing that tomorrow. All right. Have a great rest of the weekend. I will catch you all in the next video.